Dear traders, dear ladies and gentlemen, welcome. Welcome to this little free mini course. If you're here, it means that, you clicked on the respective link. Thanks a lot for that. So what I will do in this very compact video is I will try to give you an overview about the so-called market causality, which is the expression for our proprietary technology which can be used to analyze and forecast the foreign exchange markets. If you're interested in learning to become an MK trader like others did already, please follow the official guide. You can also find various videos showing the step-by-step process. Of course, subscribe to the website, subscribe to the MK web, get the video course and learn from step 1 to the last step how you can become a Forex MK web trader. In this video, I just give you a very brief overview so that you get a taste for how this looks like. Alright, let's get started. To make a long story short, as many traders know these days, the Forex markets are completely manipulated by the so-called smart money, and they conduct certain phenomena such as stop hunts, position hunts, etc. And on the other side of the equation, we have the so-called dumb money, which are the market participants who get caught in those kind of manipulation moves. And we capture that with leading information, with leading tools, so you can avoid falling into the trap of the smart money. So that's all great. Let's look at precise examples. Okay, this is a day chart of euro dollar, the world's biggest market. And let's just jump right into it. So here, this histogram, this indicator you can see, shows you live the dumb money positions in the market. The second histogram shows you the dumb money positions which are in the market plus the dumb money positions which used to be in the market. So here you can see via this histogram what's happening. Okay, green bars represent the dumb money buyers, red bars represent the dumb money sellers. And what do we see already here? Look at that. The dumb money goes into buying mode. Boom! The price of euro dollar goes down. Okay, it's literally the opposite of supply and demand, because the smart money detects that buying activity and pushes the price against those longies, as we call them. Yes. What do we see here? The opposite case. The dumb money goes short, so sells the euro dollar, and the smart money pushes euro dollar up into a multi-day uptrend, killing those sellers. Okay, going for their stops, clearing the high, taking them out. Okay, that is, as you can see, how this works. It's not the opposite. Okay, many people have the disbelief, the wrong belief that if there are more buyers and sellers in the market, the price goes up. It's not how Forex works in this day and age. Okay, you are really behind if you still believe in the supply and demand fairy tale. Now, this indicator here, we call it squeeze indicator, and it's covered in detail in the course. It shows you overall, okay, is the dumb money long or short? If the red line goes high above the green line, you know that the dumb money is short. If the green line is high above the red line, you know that the dumb money is long. And here you see really extended moves, extended trends. These are the situations where the smart money is in killing mode and wants to take out the dumb money. And sometimes both are kind of at a similar level, and then we have consolidations. Okay, so just from that information alone, you can see what's going on, how this works. Here on the y-axis, you can also see long position above the price, short positions below the price. And the next step aspect we look at is so-called stop accumulations. Okay, so next to this position hunting, as we call that, the smart money conducts so-called stop hunting. Alright, and we see those stop accumulations live on our chart. Like here, randomly look at dollar yen on the 30-minute chart. You see the green line. This is a so-called stop accumulation of the shorties, so an MTS and medium-term stop. And what happens? Boom, they take it out. Okay, and then it ends because it's taken out. And our traders see it already here. As soon as it emerges, our traders see that potential target stop accumulation. If the stop accumulation is below the price, it's the stop accumulation of the dumb money longies. Okay, so here you see we also had one MTS above the price, boom, it got taken out. With another MTS above the price, boom, it got taken out. And now we have a new MTS accumulation developing below the price. So if the short is get out of the market, eventually this can be taken, for example. Yeah. You see it better also on the 1 hour chart. We have 2 below in dollar cut. So first I took this lower MTS and now we have 2 open ones. If the shorties leave and the road is free, so to speak, they can take them. Okay? This is essential. Those MTS, those green lines, are essential. You will see that the market really moves in a way that eventually those get taken. Look at this here, pound yen on 30-minute chart. Boom, they took the upper one. Boom, they took the lower one. Boom, they took the lower one. Boom, they took the upper one. Okay, they really go for that. They are stop hunting all the time. But they will not just randomly go after a stop target. It depends on other factors, because the last thing the smart money wants is to make any dumb money traders rich on the way. So if there are a lot of longies in the market, they will not go up and take the stop. They will first shake off the longies. Once the dumb money longies are taken out, then they go for the target. Okay, remember that. It's very important. There are also short-term stops, which you see here. There are also long-term stops, which are like pink lines on the higher time frames. Like you can see here, okay, below and above in euro dollar. So we distinguish between short-term, medium-term, long-term stops. Okay, so the next thing I would like to cover is the so-called order gap zones. These are these gray boxes you see on the chart. Yeah, so this is also very interesting. These are price zones where there are open orders, and the smart money likes to go there and fill those. Okay, like here. Okay, and then the order gap zone ends like here in the euro pound on the hour chart. Okay, look at that. So we had 1, 2, 3 order gap zones above the price. Boom. They went up and filled those order gap zones. They always try to fill them whenever they can. They often use them for pullbacks or reversals. Okay, and they often do that on the way to stop targets. All right, next, option strike targets. These are those signals here, okay? These are very, very powerful, very exclusive signals. Leading signals you only get with our service. Okay, you see, we knew already here that eventually euro pound will go up and fill those. So these signals are based on option strike levels. Yeah, like the smart money will try to fill them like here, okay, to make sure to reach those little horizontal lines. Here you can see it nicely on the pound yen chart. 1, 2, okay, they go down, they fill those targets. They can be seen on the M30 as well on the hour chart. Very powerful signals, okay, like leading. You see, for example, here in Kiwi, we see already the long option strike target. It could get filled this week as soon as longies get out of the way, okay. So these are very, very powerful signals. So to summarize, okay, we looked at the stops, the 3 different types of stops, the order gap zones, and the option strike targets. Then we looked quickly at the dump money flow, okay, and then the overall dump money flow via the squeeze indicator. Okay, so in a nutshell, this is quite some information already. Now, let's take a step back and let's look at the big picture. What's going on? Why do Forex prices move as they do? Okay, and the answer is the smart money will try to move the price in a way, okay, that all the dumb money traders lose, okay, whether it is like buyers, sellers, no matter what they trade, okay, whether they trade reversals, breakouts, pullbacks, whatever it is, okay. So think about that. That makes a lot of sense. Yeah, why should, for example, in Euro Aussie, even if there would be a stop above, why should the smart money go up and take it if those longies win? No. They first need to really take out all these dumb money buyers. Once the market is cleared, boom, they can also go for the target and also kill the other traders. You see, in a nutshell, you get the explanation why over 90% of buy-side traders lose in Forex. Because they get completely hunted without knowing it, okay? You're one of the very few people now who know what's going on. And as a footnote here, I've delivered evidence for years publicly, okay? On my YouTube channel, I've traded there live for many, many years. I've documented all markets, all time frames, okay? If you don't know about that, you just haven't found that content yet. So please do your research, look at it, watch many videos to understand, okay, this is really how it works. So I've already delivered the proof of these big claims here, okay? I've already done that. So that's not new information. If you don't know that, you're just behind the others who already have studied that, okay? Now, to come back to our discussion, so what is going on? Why do forex markets move as they move? Why does it look so chaotic, so erratic? Well, the answer is the smart money takes into account the dumb money positions, the dumb money orders, dumb money stops, okay, and then it will find the best way to move the price of the forex market in a way that all of these market participants lose and they win, okay? So, they have a clear priority list, and with more tape reading experience, you have a really good feeling for what they will go for next. And that is the key to become a very good manual MK trader, okay? If you analyze the market, you see when the bias is high and when it makes sense to place a trade because the price will go for a target, yeah? Or you say, you know what, I have to wait until the price comes closer, or more the money comes in, etc., and then I take the trade. Okay, these are the details for people who want to also trade in the short term. Then you need to have like some tape reading experience. You need to have looked at the MK web for a while to understand how it all unfolds and when you can place like really good trades yourself. As a footnote here, this is the only approach which is scalable. Okay, that means if you make sure that you're always trading like that with awareness of the dumb money positions and targets, you can also place bigger trades yourself. If you don't take this into account, if you have a statistical strategy, it may have worked on a smaller account. As soon as you scale it up and you put more capital behind it, boom, it gets killed by the smart money because you simply end up on the dumb money side. Okay, this is a very important footnote. Many people do not understand that point. I've seen myself examples of people who have done well for a while, they scaled up, they collected investment capital, etc., and it ended horribly because they simply end up on the dumb money side without knowing how this works. So you can literally avoid falling into such a situation by becoming an MK Web trader. Okay? Okay, so to summarize, understand that, all right? The smart money has a very distinct way of evaluating what kind of target has to be taken first, how they can move prices in a way that people and dumb money traders who are placed correctly are not allowed to win. That means also sometimes they will go flat for 10 hours, okay, they will wait for news announcements, etc. They take all these factors into account. Remember, the execution is completely automated, okay, so it's not somebody sitting there with a button. And they will move prices in the way where most market participants, no matter what the theories were, the analysis was, will lose. Okay, even if the fundamental analysis is correct, they will be hunted, stop hunted. And these are the situations where everybody hates, where, for example, your stop gets taken out and the price turns and goes all the way in the original direction which you anticipated. So the market causality allows you to protect yourself against all of that. All right, so that's very important. Okay, a little topic. Let's also talk about the so-called 4-hour reversal dynamic. So you can see on our 4-hour charts, we have this very distinct channel here. This is just a normal statistical indicator. And you see a tendency for the price as soon as it reaches those upper bands to turn or the lower bands to turn up. Okay, now this is not enough for a trade, of course. We want to see, like here, a dumb money switch, okay? Shorties are leaving, longies are coming in. So a dumb money switch from sell to buy. So they think, dumb money thinks there's going to be a breakout to the upside. So what happens? The opposite. A so-called 4-hour reversal against those buyers. All right. So we see that all over again. Look at that. Okay. So the price goes down. All the dumb money buyers get killed. Shorties come in and they do an up move. Okay. Buyers come in again. So they retest the low until they were shaken off. You see. Then finally longies leave. Boom. And they do a big up move. Okay, so this is the dynamic. You need to be aware of this dynamic. Even if you're a short-term trader and you trade lower time frames, you need to understand those 4-hour situations. Okay, that's another thing many people don't understand. It's very valuable for you as a human trader to conduct multi-time frame analysis. That is why the MK Web shows you different time frames. So here you see that very nicely in euro dollar. Okay, the price went up. Okay, the longies got kicked out. All the shorties got kicked out. Longies come in trying to buy the high. So a dumb money switch occurs, therefore 4 reversal down. What happens then? They take all the lows, they take the stops. Sellers come in thinking the price breaks out to the downside. So boom, a complete 4-hour reversal to the upside against those sellers. Okay, taking them all out. So here, of course, even if you trade short term, if you know that the bias is bullish, you want to buy, yeah, on those days here. So you need to take this into account. Look at this aggressive down move we saw last week in euro dollar. Longest kept on buying the market, so boom, all the way down. Okay, squeeze, a long squeeze, the price goes down and squeezes out all the longies, the buyers who thought the price would go up. Doing the margin calls, taking the stops, etc. Okay, this is how this works. Now, on the day chart, you see we have those moving averages. That's not because we use them in any way for ourselves, but we look at how the dumb money uses them. And often you can indeed see that the dumb money places stops below those moving averages or above those moving averages on the day chart. And we can see that very clearly, the tendency for the smart money to clear those out. Okay, look at that. Boom. They took all 3 moving averages out with a down move. They took all 3 moving averages out. Why do they do that? They do that in order to take out the stops there. Okay, so here you see dumb money is short, selling aggressively. So what does the smart money do? They do a complete turn of the price, and after the shorties have been cleared, okay, and then also go for the stops of the longies. So this is like a house clean. You see, first they go up, killing all the dumb money sellers. The sellers collapse, as you can see from the squeeze line indicator collapse, and then they go for all the stops of the dumb money buyers. So they took both buyers and sellers out of the market by doing this kind of house clean moves. And they do it constantly on all time frames, okay, whenever they can. They use or abuse news whenever they can. And they do all of that while going for the targets and making sure that the dumb money cannot participate in those kind of price moves. Now, let's take a step back and let's really look at another footnote. Every time we have a price move like that, okay, like let's say the price goes down, of course, a lot of systems trigger sell signals. They predict a price breakout, okay, they have moving averages which cross and give a delayed sell signal. So by doing those moves, many systems on the dumb money side, whether automated or manual, get triggered and place trades exactly in the wrong way. That is why most systems fail, okay, so miserably, and why Forex is so complex. Because all the smart money needs to do is do those moves and also luring the money trades into the market, okay? By doing those big moves, they lure, you know, like for example, sellers to sell expensively into the market so that they can do a turn in the opposite direction and take them out as well, yeah? So that is how this works, okay? And don't listen to anyone who tells you all these kind of stories about supply and demand. Neither listen to all this weird stuff like this ICT thing, okay, where he talks about random factors like higher time frames and certain periods in the day. This is all storytelling. This is not how this works. It's about what does the dumb money do next, okay? Which position bars do you see? Where are the targets? That is what works, okay? So both of these approaches are wrong. Old school supply and demand is completely wrong. This whole ICT pure price action naked chart analysis is wrong. It doesn't work consistently. You need to see the information. That is the key, okay? What is the dumb money doing? Where are the targets? That is a decisive key. Only that allows consistency. None of those other two things allow any type of consistency. It's a lie, okay? Sorry to be so radical, but I've said it so many times and I've proven that with my work. And some people still don't get it, all right? But that's their ignorance. Don't be one of those ignorant people. As a trader, expect how the reality is. Have a radical mindset. Okay, say this is how reality is. How can I now trade to not get hunted and still be profitable? That's a question you should ask yourself. Cut out the noise, okay? Do not care about all of that noise. Be focused on how the reality of the market looks like. Learn it as good as you can. Prepare yourself as good as you can. Tape read, demo trade, and then go live once you got how this works, okay? As simple as that. It's not rocket science. You just need to be committed. You need to do your homework, okay? So subscribe to the MK Web. It is still super cheap. Study that stuff. Nobody can ever take this experience away from you, okay? Right, so we talked about 4-hour charts, we talked about day charts. By the way, as a footnote here, we have for a while now added crypto. So here you see also Bitcoin on a 4-hour chart. Look, we have beautiful MTS runs. Look, taken out. The upper MTS taken out, big down move. Now the upper MTS will be taken. It works the same way because crypto markets are smaller than Forex, so they will more and more become like Forex, not the other way around. Now, the only difference is the dumb money flow, because more dumb money traders tend to be long only in crypto. So that's why you see when there's a lot of longies, it goes down a lot. But as soon as a little bit of sellers, the price goes up quickly. Like here, you see a bit of sellers, boom, they do a dramatic up move. So that's a difference you need to take into account. Okay, I wouldn't short-term crypto because there's no reason to do that, but it works the same way. Okay, and by the way, as a next footnote, the same is true for the metals. Okay, let's look at gold and silver. So here gold, look what happens. Okay, on the 4-hour chart, you see we have short is coming in, dummy sellers, a short squeeze, they go all the way up, they take out all these sellers, the red bars. As soon as there's a dumb money switch from selling to buying, they do a pullback down and go flat, okay? They do the same thing. The difference to Forex here is that there may be an impact of, let's say, 20-30% of fundamental factors still in the metals, okay? So that's the only difference, really. Here, the same in silver, okay? Sellers get taken out, boom. Okay, buyers come in, buyers get taken out. And by the way, so to explain also this indicator, which is covered in more detail in the course, okay, this indicator here shows you basically the net loss of the dumb money, okay? When the red line is above the middle line, this yellow area appears. That means that some shorties are in profit. When the green line is above the middle line and the yellow area appears, it means some longies are under profit. Now, look at this example, euro pound. There were many longies, so these few shorties went a little bit into profit. So that was not so important for the smart money. They have to take out all these longies. And here there are some lucky dumb money traders that's within the so-called dumb money tolerance, okay? These sellers were allowed to win because in this particular scenario, the smart money had to prioritize taking out the longies, okay, with this down move. But eventually they tried to reverse and get those sellers back into loss as well, you see? So you see the tendency for the yellow area to disappear as soon as it makes sense. You see, so longies got killed, boom, they go up and make sure that the shorties get back into loss, okay? And this is interesting because in a way that proves to you that the smart money succeeds, okay, in getting all the money traders into loss. Look at this one. We had a short squeeze, okay, many the money sellers, the price went up. Some longies got into profit, but then, you know, once the profit got too high, and we also did the money switch, of course, they turn around, okay, the shorties are kicked out, they go for the longies, the price goes down, so immediately all those few longies who were a bit into profit are put back into loss. You understand? So this meter level, as we call it, also proves to you that they succeed in fighting both sellers and buyers, you see? As soon as there's a bit of profit, and especially if more of these traders come in, they will go for them and take them out. You understand? So you can see we have beautiful tools to see all that and to evaluate that. And maybe that looks a bit overwhelming right now, but after a while it doesn't. Okay, you get a feeling for it. Okay, like because you learn, okay, this is what's important now. We don't approach it in a simple way. We don't say long is coming, we sell. No, we try to understand the big picture, okay? The dumb money tolerance, who would be allowed to win, what's more important for smart money to do next, okay, when are the news coming, what's the best pair to select to express your trade idea, should you trade now or should you wait, should you use a limit? These are all factors which you need to learn also with experience, okay? And also, I mean, needless to say, in addition to all of this analysis, you need to have your risk management in place, okay, no question about it. You need to have a risk policy. For example, I recommend people to use stops, okay? Let's say you use balance stops, you have a target, and then your stop is roughly the same distance. You need to calculate how many lots you can trade in order to not exceed a certain risk per trade number, okay? Whether it's 0.4% per trade, 0.5, whatever it is, depending on your risk appetite, it needs to be completely defined and calculated, okay? That's essential. When you read Market Wizards, you will see the traders, they have all kinds of different trading styles and analysis styles, but the one thing which is common is risk management, okay? That is essential in Forex. Do not use martingale approaches, do not use grid approaches, you know, all these kind of approaches, they have implied blow-up risk. I don't recommend it. Try to use balance stops, okay, and not to risk too much per trade. To break down the complexity of risk management, don't risk too much per trade, be very selective, have a stop in place in case your trade idea doesn't work or you made a mistake, so that you lose a trade and you don't lose too much of the account. Because guess what? The next trades are just around the corner. You just wait for the next setups and you do the trade properly, okay? And then you improve over time. That's literally it in a nutshell. You don't need to complicate things. So we are snipers. We wait for the right opportunities. We calculate what we can risk and we place ourselves. We may use scaling by increasing, decreasing. That's all fine. Some may use dynamic stop management and all these things. But at the end of the day, it comes down to applying proper risk management. Don't gamble, okay? Number one killer on Forex is leverage. You don't need to over leverage. There's no need for it, okay? Be disciplined in your trading, in your risk management, okay? That needs to be a given, okay? So that is about risk management. Now, the third basic topic is, of course, psychology, discipline, okay, mental strength. So we talked about analysis, we talked about risk management. Let's talk about your psychology. Trading is the opposite of gambling, okay? If you want to gamble, rather go to the casino. In trading, you need to be completely prepared. You need to be impeccable. You need to be on point, all right? Everything needs to be calculated. You need to have discipline to wait for the right setup. Some days are slow, some weeks are slow. You can't do the same thing every day. You need to be adaptable. You need to be adaptive to the market. If there's a lot of setups out there, go for them and trade them. But if there's a slow day and everything is kind of low bias, guess what? Trade small or don't trade at all. If there's interest rates coming up, don't have open big trades so that you have full risk. Okay, these are beginner mistakes. Try to avoid weekend gap risk by closing most positions on a Friday. Okay, these are all things you need to do. You take into account, the news. Be realistic, and trade may on average take 10-20 hours, okay, or longer. Sometimes there are scalps, but you need to adjust to the market. Mr. Market decides what we can do and what we can't do, not you. Don't come and put some random indicators on your template and find random signals and convince yourself that this is profitable. It's not. You can have the best risk management, best discipline. It's not profitable if you have a random system. Okay, you need to do your homework. The market causality is the edge for you. All you need to do is improve on those other 2-3 things, the risk management and the mindset. Okay, so in today's world with Forex today, this is how this game works. You cannot just scalp around, okay? You need to wait for the right setups with discipline and then pull the trigger. And it's a necessity to be able to do that, to wait for the right times, to be flexible in terms of time. Forex markets are open from Sunday night to Friday night. Sometimes, you have to work late, sometimes you have to work early. It depends. You have to adjust to the market, okay? But do not do silly mistakes. Don't come up with random trades. All this here is quite objective, alright? So don't convince yourself of any setup if the setup is not great. Alright? If something switches, which rarely happens, like a dumb money switch, you have to be ice cold and cut your position. Don't let it in the market hoping it will turn. That's not how this works. You have to be ice cold. What? Something switched in the causality, my analysis is no longer valid, boom, I cut the trade, I take the loss. Next. If you keep all the trades in a certain range, you will be able to always come back from any drawdowns. Alright? But don't do things such as revenge trading, trying to force a profitable day. Because markets went flat, you don't have the profit as you thought, so you try to add another random trade. This is where you will harm yourself. You will engage in self-harm. Okay? You will come to wrong conclusions. You will make bad analysis. You will pick wrong trades. Okay, the whole point of the causality is to be able as a human trader to be profitable in today's market despite the manipulation, but that implies that you need to be professional regarding your risk management, your mindset, okay, and your discipline. We're not gambling, we are not. Okay, be puristic, alright, wait for the right setups, take them. If, for example, there's an option strike target, but the squeeze line is not turned yet, wait, or even if the price goes for a bit, alright? Don't try to be early. Try to be safe. And start small and then, work your way up. So in a nutshell, in a very compressed way, this is how you can approach Forex markets in 2024 and after, right? By understanding the causality, understanding the market structure as shown, and then all you need to do is wait for the right setups, trade the right setups, manage them in a reasonable way, rinse and repeat. That's it. Okay? It's a lot of fun. It is a lot of fun because then things are controlled. Even if you have a losing day and so on, you know the next trade is just around the corner. All you got to do is just wait for it and trade it correctly. And then you just need to keep yourself from doing silly things such as revenge trading and forcing trades into the market when there are none. That's literally it, okay? So now in half an hour, I basically gave you a little overview of the causality, the leading information. It's not based on statistics, okay? This is based on the market structure. This is a massive difference. There's a lot of technological architecture behind our charts, as you can see. Subscribe, it's super cheap. Tape read, okay, and then just trade in a reasonable way. That's all you got to do. I wish when I started out, somebody would offer something like this here. It's just amazing, okay? And as long as it's there, make use of it. I hope you like this little free mini course. Subscribe to the MK Web, alright? Subscribe to the video course. Do your homework, study, approach Forex in a reasonable way, and then sky's the limit, okay? Then you can become a successful trader. Lots of love. Take care.